All right, everybody. Great first panel. Thanks to Tyler, Nick, and to Aaron for that. I really appreciated that. That was perfect and a good starting point for us today. So we're thrilled here to have Marc Ganzi with us today, and Marc is perhaps the perfect person to have as our luminary this year, given how central the digital infrastructure space has become in nearly every aspect of our life today. For more than 30 years, he's been at the center of the digital infrastructure world, well before it became a core focus for institutional capital. He founded a company by the name of Global Tower Partners, scaled it into one of the largest tower platforms in the US, and later built a company by the name of DigitalBridge into a leading global investor in digital infrastructure. What stands out is that Marc operates right at the intersection of real estate, infrastructure, and energy, which is exactly where the industry is, and it's what we're doing at the Steers Center and where we're operating ourselves. But the most important thing is his daughter is a Georgetown University graduate from the School of Foreign Service. I learned about a minute and a half ago that Marc took summer classes here at Georgetown University. His father lived here, so spent a lot of time on campus. So yep. Had you ever been in this space before, out of curiosity?
In this exact room?
Yeah.
No.
Okay.
Well, all over campus.
So we're thrilled you're here.
Thank you.
And we're thrilled to have Riley and her friends here. So let's get started. So Marc, where did you grow up, and what were you interested in when you were young?
Well, I was a bit of a, some people joke that they're military brats, and I was a bit of a restaurant brat. My dad was a builder of a great business that owned 27 white tablecloth steakhouses. And so wherever my dad went to go open a New Palm restaurant, we moved there. So we moved around quite a bit, but eventually we settled in most of my later elementary school and high school. We moved to Aspen, Colorado. And so I spent a lot of my formative years there, and then went to Santa Barbara to go to high school at a place called Thatcher, where I finished out my high school career, and then settled on Philadelphia because I could not get into Georgetown.
Okay. Oh man.
So
I can't tell you how many times I've heard that.
I tried really hard to get in here. I was a legacy. I couldn't get in. And so my daughter trumps me there. She got in. I couldn't get in. But spent a lot of time around the campus and have always had a lot of connectivity because multiple generations of our family have attended the university. But finished up at Wharton, stayed in Philadelphia, started my first company right out of college. I went to work for a real estate developer. We were really buying Resolution Trust Corp assets and buckets and sort of slicing and parsing them. And look, that was a really interesting time. The early 90s was pretty interesting in real estate. If you've studied the sort of dissolution of the ROTC, it was a really interesting time to buy real estate. You had to take a lot of risk. You had to move quickly. You had to learn how to buy assets with no diligence, no environmentals, no NEPA, no SHPOs. I mean, you had to go quick, sometimes having to close over, problems with title. So that was exciting for me because I came out of business school and most of my friends went to New York City to go to do investment banking, and I chose to stay in real estate. And that was a really foundational decision for me because I really felt like whatever I was going to do was going to be anchored in real estate principles and tenants. And that was a good decision, I think. And then in 1995, I started my first startup. And that was basically a run for me for 32 years of building, from sort of scratch, 6 different companies. And the concept in 95, the first business we started was really with this notion that there was going to be this massive demand for real estate and wireless connectivity. And so at that point in time, there was something called PCS licenses that were auctioned off, personal communication services. This was really the 1900 megahertz frequencies that were going to compete with traditional cellular A block and B block. But that really wasn't, that was kind of the headline. The subtext was, because you moved from 900 megahertz to 1900 megahertz, you needed 5 times more of the real estate locations. At that point in time in the United States, there was maybe 18,000 cell towers. And what we saw data from CTIA, the trade organization here in Washington, that the industry was going to go from essentially just under 20,000 cell towers to 180,000 cell towers. And we said, that seems like a really good real estate business. We got to get into that. So I got together with 2 of my cohorts from Wharton. We started a business called Apex. We grew that to be the largest third-party property manager of wireless towers and rooftops in the United States. And we merged it with another company in 1999, and we took it public, and that became known as SpectraSite Communications. And so that became a really big company, and that really wasn't what I wanted to do, and I wasn't really excited about running a public company. And we'd also, out of the Telecom Reform Act of 1996, we started the first, what we called Building Local Exchange Carrier. We used to love to make up acronyms. Whenever you're doing a startup, it's really fun to create your own acronyms and create your own industry. So we created what was called the BLEC. And in the late 90s, right before sort of the dot-com hype was sort of taking off, you saw every real estate developer partnering up to try to figure out how to put high-speed internet in office buildings. And so you saw this marriage of Vornado with Vista. You saw a marriage with Sam Zell and some big private equity firms. Kleiner Perkins backed a management team. And so we started our own management team. It was called Eureka Networks. And again, the central thesis was, if we just sit at the corner of real estate and telecom, we're going to do pretty well. And so we wired up about 18,000 office buildings between Boston and Philadelphia. And we ended up selling the business to Broadwing for about $800 million. And we were the only ones that got out of that space alive. Everybody else went bankrupt in between 01 and 03. And one of the great things that I've always learned about building businesses in momentum markets is you got to know when to sell. And we knew that we were outgunned. People had more capital than us. And we also knew at some point the cable companies and the regional Bell local companies like AT&T and Verizon were going to wake up and smack us. And so we got out at the right time. And also at the same time, we had exited the SpectraSite position, my partners and I. And we watched that business go through a restructuring, and we exited at the peak of the shares at about $21 a share. And so the first two startups that we did, Apex and Eureka, were huge winners. I think Apex was 12 MOIC. Eureka was originally on the original capital, about 3.7 MOIC. And you just remember those moments because those were the ones that got you started. And it really fascinated me with wireless connectivity and finding the real estate and being the leader in that, and then being the leader in putting, high-speed fiber optic cabling in office buildings.
So where did that interest come from? Like where did that emanate from?
I think it was like all really great businesses, they happen accidentally. My partners and I have always just had this fundamental belief that, if you understand how to build the real estate that connects networks. And when I say networks is everything from hyperscale, operating cloud, operating AI, operating fiber optic networks, operating local loop, operating cellular networks. Everything is a network. A network is a living, breathing organism. And what's great about telecommunications is very few people understand it's a very real estate intensive business, Matt. And so I picked that up very early. And by being at the forefront of that in the early 90s, we just saw that there was this massive gold rush in terms of finding great locations for cell towers, finding great office buildings that needed connectivity. And then later on, as now we'll talk about what's happening today, finding great land that's tethered to power that's available today, not in 5 years or 6 years. So I've always believed that there's been this widely misunderstood language between the real estate community and the telecommunications community. And if I could be sort of that translation piece between the two, I could make a great living. I could build some really interesting companies. And at the same time, as we started evolving past the sort of second and third startup, we started applying real estate principles to digital real estate. And I think that's really where the industry started to hit its stride. And so when I left SpectraSite, I had a 3-year non-compete, so I had to take a tour of duty. I went to New York. I worked at Deutsche Bank's Merchant Bank, DB Capital Partners, for a couple of guys named Charlie Ayers and Ted Virtue. I was the telecom partner, so all I did was basically provide rescue capital to bankrupt wireless communications companies and wireless ISPs. And so we played in that sort of 2002 to 2003 bankruptcy cycle of the dot-com crash, and that was a lot of fun, actually. So I got to do that for 2 years. We made a ton of money. And then in 2003, Deutsche Bank was, because of Sarbanes-Oxley, they had to wind down the private equity group at Deutsche Bank because you couldn't have the merchant bank and the investment bank together. And so our team splintered. Everyone went in different directions. And having done private equity for the better part of 2 years, I was like, I I liked it, but I felt like I had to get back to building a company again. And so I made a decision to go out and take advantage of the busted balance sheets that all the telcos are going through. There were literally like 50 wireless bankruptcies, because back then there were 30 or 50 wireless carriers. Today there's 3. But we went through a massive consolidation play. But what was interesting is all of these wireless companies went through bankruptcy in 02 and 03. What they had embedded in their balance sheet was great real estate. And so I started Global Tower Partners. I had a clear vision for what I wanted it to be, which was I had a strong belief that it was esoteric real estate and that I could convince the IRS to give me a PLR. Everyone knows in the room what a PLR is.
No, that's the number one question never asked, because they will never raise their hand and say they don't know. So can you explain what so that's a private letter ruling, but
Yes.
What does that mean?
So every REIT has to get a PLR to get their tax status.
Okay.
And so when you get a private letter ruling, it determines that you are in the business of rental income. And that's a very specific IRS code that you qualify for. And so nobody had figured out that cell towers were essentially just small pieces of real estate. And whether you own the land, which was in fee, or you had a ground lease for 30 to 50 years, or you had a 99-year perpetual easement, heads up, it's still real estate, because you could get SNDAs, so you could get non-disturbance agreements, which are really critical to proving it's real estate. You could get leasehold title insurance. You could get title insurance if you own the land. And so we started creating this basket of entitlements around cell towers so that the collateral was airtight. So if the IRS ever boomeranged back around us and said, hey, this is not a REIT, we'd be like, hey, yeah, it is a REIT. Walks like a duck, floats like a duck, it's a duck. And so we created the sandbox around the cell towers. We created a series of files, and we just treated it like commercial real estate. No one had ever done that before. And the cell tower industry was, at that point, about 10 years old. And so I went out and I did 278 acquisitions. We rolled that up to about 12,000 towers in 10 years. And we got our PLR in 2004. And so we were a private REIT. We were not public. But then all of a sudden, the rest of the cell tower companies that were publicly traded, they were like, wait a second, that's amazing. We can shelter, income, and we can pass that through to the shareholders. And next thing you know, American Tower, Crown, and SBA were immediately REITs within 5 years of our filing. The second key sort of aha moment in me going back to the tower business in 2003 was I really felt like the asset class was completely misfinanced. And what I mean by that is, traditionally, if you were in fiber networks or you're in cell towers or data centers, you were traditionally using TMT bankers. And so what that meant was you were getting debt that was essentially club deals from banks. And at that point in time, coming out of 2003, 4, and 5, lenders were really skittish about putting capital to work in cell towers, because they didn't want to be tethered to wireless networks that were going to go bankrupt. And so we had to rethink how to restructure forming capital in the sector. And so what we did that was really interesting is in 2004, we decided to take a crack at the CMBS market. And someone came to me from Morgan Stanley and said, we couldn't find anyone to underwrite it. Nobody would do it. And we said, well, stay with us. Let's figure this out. And finally, we found a banker at Morgan Stanley, this guy, Sanjeev Kahana, who ended up being a partner of Fortress and made a ton of money doing securitizations. And he convinced, the bank that they would actually go out and they'd underwrite this with us. And he said, you're going to go out and you're going to have to do 1,400 mortgages, and someone's going to have to go in a room and sign all the mortgages. I'm like, yeah, I'll do that. I'll gladly exchange 8% cost of debt for 4.5% debt if I have to sit in a room and sign 1,400 mortgages. So I'll never forget that roadshow. That was a really interesting roadshow. And we went and saw probably 200 investors, and the book opens and no one's taking the book. And I'm like, uh-oh, we really screwed this up. And so we widened out the single A's. We moved them up 100 bips. We moved up the triple B's up 200 bips. And then all of a sudden the book started filling up. And we went out on the road and we just had to go sell it. We literally went and sold these bonds like door to door. And finally we got the book to 2x on the single A's, and we got the triple B's to 3x, and we tightened the pricing back a little bit, but it didn't quite get to where we got to. But it was effectively 5.6% paper against our peer groups, which were all public and doing, 30-year bond deals that were priced at 4 to 5%. And we were doing CMBS as a small private tower company at 5.5%. We woke the industry up. And what ended up happening from there was every major cell tower REIT now has predominantly 90% securitized paper. And there's probably been 100 cell tower securitizations since 2005. So we became the first REIT. We figured out how to refinance this as real estate. And that's where things really transformed for us. And then we had the good fortune of selling the business in 2013. American Tower came along and paid us just a little under $5 billion for the business. And it was a really satisfying moment because we had taken something, on paper that nobody thought could happen, and we could transform it. And it wasn't like we did it through magic. We did it through very simple real estate principles. Build something, buy something, make sure your collateral's tight, make sure your site files are tight, and make sure you can lease those towers to second and third party customers, which we did a really good job of. We were very good at leasing. And so we were driving sort of, AFFO growth at like 22%, which was awesome. And we had our peer group driving AFFO growth at like 12 to 14%. So those were early days in cell towers, and the knitting was pretty good. And we got a great price, and we made a lot of money for Blackstone and Macquarie. I think Blackstone made 4.7 MOIC, and then Macquarie made about 3.3 MOIC. And what was interesting is another kind of aha moment was when Macquarie ended up buying a big piece of the business from Blackstone. At that point in time, Macquarie didn't have a lot of great assets. And so they had two North American funds called MIP1 and MIP2, and they were both invested in my cell tower business. And the guy who ran Macquarie's infrastructure group, he said, look, we run a pretty boring business. We run toll roads and we pick up trash, and we have water companies. But we have this conference every year. We bring all of our investors together in New York, and we got to somehow convince them that giving us money is a good idea. Why don't you come speak to the group about cell towers and the digital real estate that you do? So in 2010, 11, and 12, I got invited to their AGM. I didn't know what an AGM was at that point. But all of a sudden, I was in a room with 80 to 90 investors, and I was like the most interesting guy in the room, which is like being the world's tallest midget, because it's like a bunch of people running, Puget Power and Waste Management. I think I look pretty good sized up. And they're great CEOs, but they didn't really have much to talk about. So I was kind of the one table, like all the LPs wanted to come talk to me because they wanted to figure out what cell towers were. So very astutely, I just started taking cards. And, after doing it for 3 years, I had a Rolodex of like 200 of the world's biggest LPs that were allocating 3 to 4% of their real asset pie to infrastructure. And I said, wow, I'm basically forfeiting a 1.5% fee and a 20% carry to Macquarie, and they're doing nothing. And I'm doing all the work. There's got to be a better way to do this. So I sold the business, and in 2013, I had breakfast with the partner at Blackstone that was in charge of my investment, a guy named Ben Jenkins. And Blackstone had gotten to be really big, and he'd gone to Asia to open up Blackstone's Asia business and did the deal with CIC. And he came back, and Blackstone had totally changed. And I said, well, what are you doing? And he goes, well, I go to these Monday meetings. I go to the Monday morning meetings. I go to the Thursday IC committees, and I don't know anybody. Blackstone's totally changed. And he said, what do you want to do? And he said, I want to go build great companies. I said, that's funny. That's what I'd like to go do. And he said, well, how do we do it differently? And I said, well, let's make a commitment right here and right now at this breakfast table. The world doesn't need another GP. We lied. And so what we hatched was interesting, which is we wanted to be a fundless sponsor. That was kind of the concept. He'd made a lot of money in Blackstone stock. I'd made a lot of money through the various companies that I built. And so we decided to go out and buy companies with our own money in a sort of an old merchant banking model. And then as companies got bigger and evolved, we'd go out and I would open up that Rolodex of that 300 people that I met through Macquarie, and I would invite investors to come direct with us, not in a fund structure. So we went out, and from the start of DigitalBridge in October of 2013 until about 2016, Ben and I bought 6 companies. And we did it usually with our own money, and we put up our own deposits and put up our own break fees. And finally, we got to our sixth deal, which was buying a business called Vantage. And we were buying it from Silver Lake. And Silver Lake did not love this company at all. They really didn't get it. It was building hyperscale data centers. This was 2016. No one really understood what big hyperscale cloud computing was. And we were going to pay $1 billion for this business. And so we run into this auction. And by the way, we'd already written, between the two of us, we'd already probably written about 180 million of checks in the first 5 deals. And we had raised about $3 billion of co-invest in those first 5 deals. And we didn't charge 2 and 20. We decided to charge 90 and 20. But what we decided to do was there was no hurdle on the carry. So it was a 20 over a 0, if you can grasp that. So we exchanged fee for carry. And we were, instead of putting up a GP stake, Ben and I were typically writing, $20, $30 million tickets in every deals personally. So we put a lot of our own money in each deal. We lowered the fee and we upped the carry. And finally we got to Vantage, and we were buying this business from Silver Lake. I'll never forget this. My daughter won't forget it because it was a Christmas 2016. I think I was in my office for 12 straight days. I didn't come out of the office at home in Aspen. And finally, Christmas Eve, we signed the deal. And I'll never forget it. We were negotiating with Greg Mondry at Silver Lake. And he said, look, I've got KKR, I've got Brookfield, and I've got Blackstone that all want to do this deal. But because I compete with them, I really don't want them to win. And I want to take a chance on you and Ben. He said, but those guys are willing to give me a 10% deposit on their equity, and they're willing to write an ECL. What are you going to do? He's like, I need a break fee. I need a $60 million break fee. Ben and I personally wrote the break fee. And Greg Mondry goes, well, how do I know if you have the money? And Ben faxes him his brokerage account. And I was like, what are you doing? You're sending Greg Mondry your brokerage account. And that's what we did. We took risk. We took really big risks. And Vantage, once we got the story put together and we hit the road, we raised the equity in like 3 weeks. And that was like 500 million of co-invest. We got 300 million from PSP and some other folks. But finally, we'd reached a point where we're like, okay, $1 billion deals, we probably need a fund. And so we broke our promise. And in 2017, we launched our first fund, the first ever digital infrastructure fund. And we sort of targeted raising 2 billion, and we ended up raising 4.7 billion. And that fundraising tip to tail was 9 months. I mean, that's how people were really very interested in our sector. And then the rest is kind of a really weird journey where we did this reverse merger with Colony Capital. I became the CEO of that business. We sold $56 billion of real estate in 24 months in the middle of COVID when you and I first met. And then we rotated to about 120 billion of digital real estate. And it was the fastest transformation in a REIT, I think, ever.
So can we camp there a little bit, right?
Yeah, sure.
So
I just wanted to gloss through that really fast.
Well, you talk about conviction.
Yeah.
Right. And you basically came in, and we've had Tom Barrick here. You basically turned that thing upside down and emptied it all out in a very short period of time. So
yeah.
Can you talk about being inside the company at that point in time? What was the discussion like, or was it just we're selling everything we got and we're going big on digital, or what? I mean, what was going on there at that moment?
I think there was, just being very intellectually honest, I think there was 2 things happening at the same time that you sometimes get these confluence of events that happen. And for one, we had bad real estate. The minute I got there, I met with all the product teams, and it was very clear to me that the merger that he had done with Hamamoto was a bad merger, and that the best portfolio we had was our light industrial portfolio. And so I said, if you're really serious about this, Tom, and you really want to rotate everything into digital real estate, we're going to have to do our first deal at the tightest cap rate possible. And so we had 2 buyers for that business, and I wanted to do something quick so that it was big and impactful because we were making this announcement on rotation. And one of my classmates from Wharton was Jonathan Gray, and I said, if Blackstone's one of the 2 bidders, if it's it's basically A and B and Blackstone, let's try to get something done with Blackstone. And so we flew to New York, we met with John Gray, and we had a handshake in like 40 minutes. And we got that deal done at a 6.1 cap rate or something like that. And it was not good industrial. I'm just going to be honest with you. It was bad industrial. But Blackstone is such a thematic investor, and they wanted to be an industrial at that point in time. In 2019, industrial was their key thing, just like digital is today for Blackstone. So we sold that and made 2.7 MOIC and pushed a bunch of capital back to LPs and pushed a bunch of capital back to the balance sheet, which was important because we had about 17 billion of debt at that time. And one of my key things is when I took over the Colony balance sheet is we were levered at like 40 times EBITDA. And I was like, that doesn't work. And so the second thing that was happening besides us not having great real estate is we were massively over-levered. And I knew we had to get out of the leverage as fast as possible. So we made quick deals to sell our hotel portfolio. We had 2 different hotel portfolios, and we got those sold right in the middle of COVID. I don't know how we did it, but Moelis did a great job, and we got that done. And then we turned our energy into selling the medical portfolio. And there was a very complicated structure. We had a bunch of partners and a bunch of weird debt structures. And basically, we flushed the whole portfolio and broke it up into 3 pieces and sold it in effectively 6 months. And then the last piece was the legacy, Colony Capital, private equity and debt business, which had kind of fallen on hard times. And Pete Bridger had sold Fortress to SoftBank with Wes, and he created sort of new Fortress, and they needed scale. And so known Pete and Wes a long time. Pete came to see me with no assured and said, look, we know you're getting out of the real estate credit business. Smart move. We need scale and we need Europe, and we're happy to buy it for you. And they paid us $800 million and took all the cats and the dogs. So literally in 24 months, we were down to 300 million in debt. We'd sold 56 billion of real estate, and we had 800 people globally, and we were down to 320 people. I think at one point in time we had 400 or 500 million of SG&A, and I got our SG&A down to 120 million and just turned the REIT around. Was making money again. But the problem was we were growing so fast in digital, and we were growing so fast in our tax REIT subsidiary, we could no longer hold the REIT. And we had made critical investments off the balance sheet in Vantage and in DataBank, which were exponentially growing, but our asset management business was growing at like 50% CAGR. So we'd gone from, when we merged with Colony, Ben and I had about 22 billion of AUM, and that was in 2019. And then fast forward to 2025, we're at 118 billion of AUM. So we had to de-REIT, which was unfortunate because I was hopeful we could keep the REIT together and build the largest global diversified digital REIT in the world. So we had to de-REIT. That was complicated. We were still public at that time, but we're still public today, by the way. And we had to rotate our shareholder base. So imagine you've got 300 shareholders that are REIT investors, and now you've gone from being in the REIT sort of sandbox, and now you're being judged solely as an alternative asset manager. So my peer set was Digital Realty and American Tower, which I could compete with them, I could talk like them, and I could stay ahead of them from an investor cycle, to now I'm competing with KKR, Brookfield, Blackstone, Ares, and Apollo. I had to move up in weight class really fast. So imagine you're sort of fighting as a lightweight, but you're being put in the heavyweight ring, and you got to go figure out how to fight. And so we figured that out. We rotated all of the shareholders in 4 quarters. Stock was really volatile, moved around a lot. There's some tough days where we questioned whether we should stay public or not. But we eventually figured it out, and we've been sort of growing FRE by 25-30%. And our multiple today is the leading multiple of any alternative asset manager in the world. So we've done a good job, but it wasn't exactly sort of point A to point B. There was a lot of interesting moments in between there, and still very grateful to Tom. Tom's a dear friend. I've known Tom Barrack since when I went to Thatcher, and he's really, really dear friend. And I'm thankful for the opportunity that he gave me to come and help fix Colony. And to this day, we're still friends.
So can you talk about how you think about speed? I mean, obviously you worked very quickly there. So how does speed factor into the way you think about building businesses or turning businesses around?
Never let a good crisis go to waste. When you've got bad news or you've got bad assets, whether it's sitting on your balance sheet or whether it's sitting in a fund, a lot of people make a big mistake of holding on to bad assets thinking you can fix them. They usually are what they are. So we talk about this a lot today, like in the funds. Not all of our assets across I think today we have between continuation funds, credit funds, and our flagship fund, we have 14 different vehicles, and they're not all top performing assets. You have some businesses that aren't going well. And the best thing you can do in running a portfolio is if something isn't working and you don't have strong conviction on how you're going to fix it, you got to sell it. And even if you got to market to market and sell it, you got to sell it. You got to move on, because it's really the toxic businesses or the toxic assets that really hurt you. And if you think holding them because you're getting a management fee and that you can accrue, or you've got some magic bullet to fix it, I can tell you now, doing this 30 years, usually there's not a magic bullet. There's not some new technology. There's not some new zoning classification that's going to change the real estate and make it better. So I've learned to be pretty quick when we've got something that isn't working. We either change it or we sell it, and we go fast. And that's been a really good mantra of the firm, and that's worked well for us. And I would say that, the other thing about going fast is we've always been the leader. So we've always been the first to sort of go through and sort of make these decisions in investing in this asset class. And there's a lot of fast followers. And so we're never afraid to keep innovating. And we also believe in a lot of communication at the firm. So we have 5 standing meetings every week where the whole firm gets together, but those meetings are 30 minutes and they're intense and they're quick. And I believe in just moving fast. And it's really important when you're in investment committee and you're making decisions as a team. We always say it's better to get to a no quickly than to get to a prolonged maybe. Investment committees don't function when the same deal keeps coming back around week after week and people are saying, okay, I'm going to tweak this. The diligence is going to tell me that. We're very, very good at saying no quickly. That level of efficiency really helps the firm a lot, because what it does is you don't waste a lot of time in dead deal costs. A lot of firms will sort of stay in an auction too long. We don't win auctions. We generally are 80% of our deal flow, 80% of our successful deals we do are proprietary. About 20% comes from a bankered process. So we've always navigated away from auctions, and we've always tried to find great leaders and great CEOs that we could back, that we have conviction in, and that we can bring all of our resources to bear, Matt, to help them go grow business.
So you talk a lot about conviction, and that plays into speed. So how do you develop conviction that allows you to move that quickly?
I think, we've gotten really good at knowing what works for us from a returns perspective. And then having what we call we call something the sandbox. Claude, the juniors are now calling it something else because Claude has figured out how to call it something else. But we had a fundamental belief like a decade ago that there was a sandbox of assumptions that we sort of drew 4 walls around. We said, look, if it fits in this sandbox, you can go fast. If it doesn't fit in that sandbox, it has like a 90% mortality rate. And teaching the team that and having them have a common language across exit multiples, financing assumptions, churn assumptions, growth assumptions, CapEx assumptions, all the things that drive returns, and making sure there's a common language across the firm and that our junior team is being trained in that common language is so critical. And now with AI today, it's incredible. Our ability to iterate different probabilities and outcomes now in models is stunning. What used to take us a week, we'd say, okay, go back and go do this, and this, and we'll see you next week. Now we can say, go back and do this, and this, and we'll see you in 3 hours. And the team will come back literally on a video call, and they'll say, yeah, we ran all the iterations and here's what it is. I think investment firms that really understand AI and how to use it in a way that speaks your language, that I think a lot of investment firms make the mistake that you first have to build your own investment language. And we've spent the last 3 years building our own LLM, and we call it DigitalBridge. DigitalBridge is the language that we use for everything in the firm, whether we're talking to an LP, whether we're taking a deal through investment committee, or we're asset managing that deal. We're using a common language that allows the firm to keep thinking 24/7. And I think that's what we're hearing now from other firms, whether it's Blackstone does this, they have their own system that they use. We know that Ares has a system they're developing that's very similar to this. And so your ability to move quickly and have a common language that everybody understands allows you to have speed so that when it's time to go kill a deal, you can put two or three people on an airplane and say, go get in a law firm, go sit in that room and go close that deal. And we still do that. Because with AI, the ability to do diligence quicker, put the investment committee deck quicker, put the model together quicker, it frees up time. And people say, well, you're going to replace all your associates and analysts. I said, no, I'm not. I'm going to do what they really should be doing, which is they should spend more time at the asset level. They should spend more time in the investment committees at the portfolio company level, making decisions around new construction, new M&A, thinking about how to work with customers. Somebody asked me the other day, they said, well, if you were to take your company private and you had 60 extra days every year, what would you do? I said, well, I'd probably go spend more time with customers. And so now what we're doing as a firm is we're teaching our associates, analysts, principals, and VPs to go spend more time in the portfolio company, spend more time with CEOs, but most importantly, go talk to customers. Because our best ideas always come from working with customers, which are tenants. When we can work closely with Google, we can work closely with Meta, or we can work closely with NVIDIA or OpenAI, that's honestly, Matt, where we get our best returns, is when we're doing proprietary new builds, new construction, or joint ventures with our customers. And I wish I had a Gantt chart that I could throw up and show you the difference between deals we've done directly with a tenant versus deals that we've done through an investment banker. The returns are like massively wide, probably 400 to 500 basis points wide.
Man, on our organizing call, you talked about this concept of how you guys navigate to win, and it's a concept that we discussed. What does that mean? What does that mean to you, and how have you consistently won over your career?
I think there's two ways I think about winning. Well, three ways actually. The first is I really want the counterparty that I'm negotiating with to walk away and saying they didn't lose. I think that's super important. I think if you have a mentality where you have to take everything from someone, you're never going to get the repeat business. And so it's not like a real deep secret that we've gone on to do repeat business with a lot of people. I was with the CEO of Liberty, which is a big publicly traded, cable and media company. We've done 3 deals with Liberty. And now I've just sold Liberty something. So it's now a 4th deal. And we've been able to transact with them time and time again because we don't scorch the earth in a negotiation. I think you always have to leave a little something on the table for whoever you're negotiating against. That's really important. Number 2, and this is maybe more important than number 1, the customer's always right. Like, how easy is that? Learned that from working in the restaurant business when I had to go bus tables at my dad's restaurant when I was at Wharton. That's some people lose that concept. And we're really clear with our customers that if they feel like we haven't done something right, and even though we know we're right, we still go to them and say, let's make it right. And I think that's super important. And last year, I think our 11 data center companies were 40% of the global leasing market. Wow. We had 40% of the market share last year. We don't run around advertising that. And people, our team says, well, why is that? I said, well, first of all, we've been around for multiple decades. Second, we're a trusted partner. And third, we're really fortunate that like our top 6 customers really don't like a lot of people. And they don't really like allowing a lot of people into their TP. And so by being there early in 2013, 14, 15, and 16, and building trust with Microsoft and Amazon and Google, we've become a trusted set of hands. And so that elasticity with customers, specifically with tenants, where we've delivered for tenants, we're on time with tenants. Another thing, we're never the highest rent. Like, you go to all of our data centers here in Dulles, between DataBank and Vantage, I think we have close to 30 data centers here in Virginia. We don't have the highest rents. I never want to be the guy that has the highest rents. In the cell tower industry, we were always well below American Tower and Crown. Why? I don't want a bullseye on my back, because renewals are coming. And by the way, this is the first time in the tower industry that customers are leaving towers in 25 years. None of the tenants are leaving my towers because we haven't extracted that extra pound of flesh out of them. The last thing I would say is it's really important to celebrate with your deal teams and to celebrate with your management teams. So whenever we have something that's big that happens, whether it's a refinancing, you've sold something, you bought something, we believe in celebrating our successes, and typically we'll do that with our management teams, and we'll go somewhere fun. We'll go fly fish, we'll go mountain bike, we'll have a great dinner. But we have really very close-knit team. It's kind of a family concept of how we run the company. And we think of our portfolio companies as not somebody that we have to go and stand over their shoulder and say, do it like this. We look at them as our partners. And so we embed typically 4 to 6 people on every deal team. And part of your job is every quarter is to go spend at least 3 to 4 days in the portfolio company, working at the portfolio company. And again, not being a snitch, but being on top of them and being a part of the team, and really having them accept us. Because when you build that fundamental layer of trust, then people want to work a little harder and they want to win. Those are just sort of 3 examples of winning.
Love it. So for those who may not follow closely, can you explain in simple terms what you do now at DigitalBridge? What does the company do?
So today we are a $120 billion global asset manager. We have a series of different fund products where we provide capital to people, whether it's equity or debt or some hybrid form of capital. And I would say, if you looked at our composition of CapEx that goes out the door, I would say today we are 80% greenfield and 20% brownfield. Now, if you went back 10 years ago, it would have been the other way. Would have been 80% brownfield and 20% greenfield. But a big chunk of our business today is building. And I think in a market where we're never going to pay more than Blackstone, we're never going to pay more than Brookfield. We just won't. We're not going to be that. We're not going to be that buyer. So when digital infrastructure became really popular and every alternative asset manager is now in the data center business, we sort of chuckle. And we laugh because we've been here for like 30 years. This is our neighborhood.
Yeah.
And all these guys are showing up in our neighborhood. And the pivot move for us was about 3-4 years ago is we've been focusing on greenfield, but greenfield specifically attached to a customer. And I always say these kind of aha moments in your career. The aha moment for me was I was here in Virginia at a board meeting for Vantage in 2023, and we'd gotten a letter from Dominion saying we're out of power. I said, what? What does that even mean? I mean, Dominion is a great power company. There's all these power lines around here in Hardin County and Fairfax County, and like there's data centers everywhere. There's plenty of power. And they said, we've run out of transmission capabilities. And the next upgrade to the grid is 2028. So that was 2024. And I'll never forget that. I was flying back home and I was sitting with my partner, John Mock, and our CEO ran Vantage, Surreal. I said, we have a really, really, really big problem. If this is happening in Virginia, this is going to happen everywhere in the US. And we need to immediately find the #1 consultant in the US that understands baseload and understands the grid. And we need to start getting smart about the grid. And in roughly about 22 years ago, we built our first microgrid. And a microgrid is essentially your own power company. And of all places, we chose Tambor, Brazil to do it. And we have the largest data center business in Brazil called Scala. And we were getting all of our power through hydro. And if you've ever been to Sao Paulo, Brazil, you'll know very quickly the grid there is horrible. They have more rolling brownouts than California. And so what we did is we built the largest cluster of data centers in Brazil in Campinas and Tambor. Those were the two availability zones that Amazon wanted very badly. And so we leased our own transmission line, and I bought 1.3 gigawatts of hydro 2 years ago. And people thought we were nuts. But we were buying that hydro at like 3 cents per kilowatt hour. And by the time we leased the power lines and we built our own substations, which were microgrids, we were effectively at about 11 cents per kilowatt hour. The grid in Sao Paulo is like 25 cents per kilowatt hour. It was a massive competitive advantage for us. The other thing we got to do, because it was pre-Trump, we got to say, hey, Scala is the first 100% green data center operator in the world. We operate 100% of our power is hydro. And we were only operating like 300 megawatts of data centers. You know what we did with the other close to 800 megawatts? We sold it back to the grid. So every day we're pushing hundreds of megawatts of power back into the Sao Paulo grid. And I'm selling it at like 25, 30 spot. And I'm creating it at 12. And like the light goes on, and like, wait a second. If we can figure out how to build power adjacent to our data centers, and we can do it with solar, and we can do it with wind, and we can do it with hydro, and we can do it with battery storage, like we've got something. And so we then started running around and trying to find as many people we could find that could build microgrids. And now we've built I think we just activated our 6th microgrid in Reno, Nevada. And our microgrid in Reno, Nevada is 1.3 gigawatts. The entire grid for the city of Reno is like 1.1 gigawatts. So just our microgrid that powers Tesla's battery factory and our 28 data centers is bigger than the entire city of Reno. And we do that entirely independent. And I sell spot between 100 to 200 megawatts every day back into the grid. But I don't just sell it to Nevada Power and Light. I then took an old fiber concept called interconnection. So every utility company in the United States is interconnected to the regional grids. There's about 6 regional grids in the US. And so what we figured out is Reno sits in the upper northwest corner of Nevada. We were selling power to Puget Power, Portland General, Pacific Gas and Electric, Nevada Power and Light. But all these guys were buying power from us at like literally last quarter, our spot rate was like 110 per megawatt hour. And we're producing that power like 38.40. So we figured out how to trade power. And so you ask me, what are we doing today? I tell people I'm in the power business. But it's kind of like the story of my career. I've just been accidentally, I've sort of fallen into these situations. Like I fell into cell towers in 1995. I've fallen into building microgrids in 2025 and 2026. And now what we've done, which is really interesting, is we have 23 gigawatts of power. So if you accumulate all of the data centers that DigitalBridge owns, we have a power bank of 23 gigawatts available to us. We're only using 5.7 gigawatts. So the largest producer of independent power in the United States today, does anyone know who it is? Of private power? Anyone want to take a guess? It's publicly traded. So that narrows it down. NextEra. NextEra produces 82 gigawatts of independent power every day off their grid. This is off-grid power. We produce 21 gigawatts. So we very quickly have become a developer of power, but that power is our access key to getting leasing. And the reason we sort of led the league in leasing last year is because we had power. And we'll lead the league again this year in leasing. I think this year we've already leased, someone told me we've already leased about 3 gigawatts. We've got about 12 gigawatts in development. So we're going to stay in front of this. And the only thing that keeps you in front of the game right now, Matt, is power. And your ability to have power, and your ability to be grid connected, and your ability to sell power back into the grid. So that's where we evolved to.
So if you have that much of a bank and all we hear about is the insufficiency, where's it coming from?
So for us, it comes through 7 different sources of power. We have grid connectivity. So we get today about 12 gigawatts comes from grid connectivity. And that's really, those were will serve letters that we acquired in 2018, 2019, 2020, 21, where we were early and we were able to get like Dominion. At one point, we had 600 megawatts from Dominion. From Nevada Power and Light, we have 500 megawatts. So we were able to stitch together a bunch of commitments. In Atlanta, we've got 1.3 gigawatts from the Southern companies, from Georgia Power. And, I would say today we're probably almost a little under 2 gigawatts in solar. I still love solar. I think solar is easy to deploy. It's very efficient. It converts quickly. We probably have another 600-700 megawatts of wind. We've got close to 2 gigawatts of hydro, maybe more because we're doing more hydro in Quebec. We really like hydro in Quebec, and we like hydro in Brazil, and we like it in Nevada. Those are the three places we have a lot of hydro. We have a source of energy called BESS, which is battery storage. Every day, we're generally storing about 600 megawatts. We partnered with Tesla, with Elon, and we've figured out how to take his Tesla battery pack, which is about, his biggest one is about 64 megawatts. And we figured out through his engineering how to daisy chain them up and get to like 240 megawatts. So that's a massive amount of battery storage. That's more than any battery storage anyone has. So we've created this concept with Tesla called the Mega Pack, and we're deploying probably like 12 to 14 mega packs right now all around the US. And so that's been a really successful partnership. So battery storage is important. And then right now, just LNG. I'd say probably today, if you look what's in our backlog, we've got 40 gigawatts of power that we're working on to build today. I'd say probably close to half of that is LNG, including the 9 gigawatt project we announced in Ohio with SoftBank Power and the Department of Energy a couple weeks ago. And these are big projects, Matt. I mean, what we're building is the next generation of compute, which is AI factories. And I think what you'll start hearing less about data centers. You'll start hearing, over the next sort of 5 to 6 years, you're going to hear a lot about AI factories.
So define that, please.
So AI factories are really massive centers of compute that is shared infrastructure where you not only have a hyperscale tenant, but sort of co-located with that is government agencies and enterprise customers, all super focused on building and deploying AI workloads and industrial use cases. So think about it as the industrialization of AI. And really, AI has kind of gone through 3 phases, right? There was the first phase, which was the building of large language models. And we're kind of, I would say, 65-70% through building out LLMs. And then the second phase of that is inferencing, which is ultimately when the model starts thinking for itself and it starts making decisions, you move to inferencing. And then sort of the third phase of AI, which I think is the most interesting part, is really this industrialization of AI. So that is actually pushing AI into the enterprise, pushing it into actual factories, and putting it into what I would call industrial use cases. So we look at, for example, I'll give you a couple of industrial use cases that are going to be completely driven by AI. I'll go back to the waste business. So the trash business is changing radically. It used to be a very, very heavy unionized, a lot of trucks, a lot of moving things from point to point, then recycling it, but very heavy on manual labor and kind of a 6 a.m. to 5 o'clock type of operation. The waste business in 4 to 5 years will be autonomous trucks with robotic arms and with robots doing probably 85% of the work. So what will that mean? What will the people do? The people will be sitting in control rooms. The people will be sitting in recycling areas. And that workforce is going to change. But the productivity goes from a shift that's 6 to 3 from having 3 shifts, right? So 3 shifts that kind of go in kind of 8-hour increments. And those trucks will just keep moving. And that harmonization between optimization of the truck route, optimization of the robotics, the optimization of when it picks up a piece of trash and it puts it into the truck, What happens is the AI sorts all that trash. So by the time it gets to a waste facility, you're not sorting through the trash at the waste facility, but you're sorting the trash as the truck goes autonomously. All of that is based on large language models, and it's based on a commitment by that industry and that company to go to a model that is 80%, 90% robotics. And just to talk about robotics for a second, to build AI, we now have figured out it's going to cost us about 300 gigawatts of power. And keep in mind today, the public cloud is about 68 to 70 gigawatts. So we've been building public cloud for 13 years. We've been building AI for 3 years. And so the amount of compute required to build AI is 3x bigger than public cloud. Robots are going to require 500 gigawatts of compute, robotics. And I'm not talking about humanoids. I'm talking about everything that is going to be considered robotic. And those aren't my numbers. In the last, I'd say 2 years, I've gotten to know Elon casually. I've gotten to know Jensen pretty well. Now I know Masa extremely well. These are 3 people that I think really have a very good front row seat to what the future is. And the future is robotics. And so to go make robotics work, we're going to need a massive amount of real estate. We're going to need a massive amount of compute and power. And so I'm looking at that, and I'm looking around corners. I'm saying, where are we going to get it? Where are we going to get all this power? Where are we going to get all this compute from? But that's what's around the corner. In a decade from now, you will be interfacing with robots frequently and often, and they will all be driven off of algorithms.
Whoa.
Isn't it exciting?
My hair's blown back even more than normal. But so I don't even know where to start. So are you optimistic about our future based on what you're looking at?
Yes, I'm always an optimist. I am optimistic. I think we have structural challenges. And those structural challenges have existed through any tectonic shift in technology. I think this one's a little harder to get your mind wrapped around because we've added a zero, and we've compressed the speed at which we need to build it. So something has to give. And I do worry about the physical capability of the infrastructure in this country. I think that we've had a problem with power for a long time, but we have a problem with all sorts of infrastructure in this country. And so the question is, can we use AI and can we use robotics to not only become more efficient and drive the functionality in enterprise, but can we actually use robotics to go out and help build what I would call sort of common infrastructure for the good of the country? I think that'll be a real fulcrum issue for us if we can use robotics and AI to actually do the hard work that this country needs to do. Which is everything from bridges to roads to airports to air traffic control. There's so many things wrong with our infrastructure that the hope is that that AI layer on top of that could hopefully help us move quicker and move faster in terms of some of the challenges we have. So I worry about power. I worry about water. Really good friend of mine from grade school who's a water expert, and you spend an hour or two with him and you get really depressed pretty fast because we're running out of water, and we're really running out of water fast. And that's totally on display in my hometown in Colorado right now, where the runoff is done. It's April. The runoff's usually in June. This is going to be the worst drought that Colorado's ever had in the history of its state. And so we can't pretend that doesn't exist. And so the things that we can do to help that, we're building cooling systems that recycle the water. We're spending time now on CO2 recapture. There's 2 really interesting companies that we met through one of our LPs, GIC, that's backing massive CO2 recapture. That's a great way to bring energy back into a data center without wasting it. And we've got to figure out how to be better stewards of the planet, I think. Not to be sort of altruistic about what I'm doing, but we need to do that. So I do worry about the physical limitations of the infrastructure. And the hope is that we can have some really great breakthroughs in both of those issues, water and CO2 recapture, because we've got to start changing the narrative.
So I feel like we're just getting started here and we're out of time, but
Sorry.
no, not at all.
So I'm optimistic.
Okay, good. So if you were 22 again,
Yeah,
knowing what you know now, and you're 22 right now,
right now.
where would you be winning and you know, what would you be doing right now for like the next, you know, period of your career?
Look, it's hard to sort of be at that age today and say, where am I on the AI trade? Because, you know, to pretend that AI is not an opportunity or is not going to change the trajectory of those of you that are students in the room, it is. It's going to change what you do. But there's no substitution for great interpersonal skills. And the people that I'm hiring in my firm today, I'm hiring strong EQ.
I love it, baby.
Because the reality is the IQ is going to be embedded in DigitalBridge and the language we use and the things that we do. So I need great people. I need people that have great interpersonal skills. I need people that know how to go out and find that great next CEO and know how to win their trust and to make them want to work with us. Because the difference between, you know, alpha creation, someone asked me a couple weeks ago, I was speaking to someone, and they said, what's the secret sauce? And I said, well, the secret sauce is really, if you have the right CEO, they're top quartile. So if I had to look at my top 5 or 6 CEOs in the last 10 years that have delivered greater than 3 MOIC, it's because they were just great with customers and they were great with their employees. And so finding amazing talent and finding great people is the business that I'm in. Because the rest of the stuff is somewhat commoditized, right?
Totally.
Information, you know, we don't have any special sauce on information. No more better than what Brookfield or Blackstone or Apollo or Ares has. But where we're going to win is we're going to win on having great management teams that go win the hustle points and the jump balls. That's what my high school basketball coach used to say. You know, the stats that don't show up on the line is, you know, I want to win the 50-50s. You know, every good coach in hockey or every good coach in basketball says, if there's a 50-50, you want to go win it. And we want to win the 50-50s. That's absolutely critical. In the trenches, you got to win the 50-50s. And also, you just got to work a little harder. You know, it's everyone has good ideas, but the difference between idea to execution is what the alpha is in investing. And so I spend a lot of time, now that we have more time, we have more information, Matt, you can really pick a deal apart and you can really sort of parse through the alpha. And you can say, okay, well, my base case was here, but if I have sort of a wedding cake and I sort of layer up the returns, which is kind of a game of chutes and ladders, right? Because there's things that go right and things that go wrong. That ability to take an investment from where you entered to where you exited it and sort of pick apart the 5 or 6 things that really matter, that really is the business we're in. How does it relate?
No, man, it's great. You know, I would say one of the things I love about my job is the people I get to talk to. And like this ranks up there in my top handful of people I've talked to. This has been massively interesting. I could go for another hour without a problem. And I'm grateful for you spending time with us here today. Come back, man. We want to do the second hour again. We love you at Georgetown, but can you join me in thanking Marc Ganzi?